All right, welcome back to the deep dive. Today, we're really diving headfirst into your sources on U.S. personal taxation.
Yeah, let's do it.
Think of this as, your shortcut to understanding a pretty complex system and maybe uncovering some ways to keep more of your money.
That sounds good.
Our mission today, unpack the basics of U.S. tax, look at strategic filing choices, and see how dependents can actually unlock significant tax relief.
Exactly. And what's really fascinating here, I think, is how much your personal circumstances intertwine with the tax law.
Right.
These aren't just like dry rules on a page. They really shape your financial relationship with the IRS. So, yeah, let's unpack it.
Okay, let's kick things off with what you called the master key earlier. Your U.S. tax residency status. And it's crucial, right? And totally separate from immigration status.
Totally separate. Yeah, I get this wrong, and everything else gets complicated fast. It's the absolute foundation.
So what's the main split?
Well, the core distinction is between a resident alien and a non-resident alien. Resident aliens, they're taxed on their worldwide income. Everything. And they file the standard Form 1040, get access to pretty much all the U.S. citizen tax benefits.
Worldwide income.
Wow.
And non-residents.
Non-resident aliens generally are taxed only on income from U.S. sources, and they file a different form, the 1040-NR. Their benefits are significantly restricted. That difference in what income gets taxed is huge.
Okay, so how do you figure out which bucket you fall into? Seems pretty critical.
It really is. There are basically two main tests. The green card test, that one's simple. If you're a lawful permanent resident, boom, you're a tax resident.
So straightforward enough.
The other one's more complex. The substantial presence test, the SPT. That one's based on the actual number of days you're physically present in the U.S. over a 3-year period. And it uses this weighted formula.
Ah, okay. Now, I've heard about exceptions here, these exempt individuals. What's the deal with them?
Right, this is an important point. For certain people, like students on specific visas, F, J, M, or Q, and some teachers or researchers, their days in the U.S. simply don't count towards that substantial presence test, at least not for a set period.
For how long?
Well, for most students, it's their first 5 calendar years. But here's the catch, what some call the tax cliff.
No.
Once that exempt period ends, say for a student who's been here longer than 5 years, they almost certainly meet the SPT overnight. And suddenly, boom, they're a resident alien taxed on a worldwide income.
Wow.
It really requires some proactive planning. You need to file Form 8843 each year you're claiming that exempt status to. It tells the IRS what's going on.
Okay, so planning is key. But is there any, escape hatch? If you do meet the SPT days test, but you feel like your real home base is somewhere else?
Yes, there is. It's called the closer connection exception. If you were in the U.S. fewer than 183 days in the current year, and you maintained a tax home in another country, and you had a closer connection there, things like a permanent home, family ties, bank accounts back there, you can still potentially file as a non-resident alien.
Oh.
You'd file Form 8840. It formally makes that claim to the IRS, arguing for the closer connection.
Interesting. So residency sets the big picture.
Yeah.
But then there's another number that matters a lot, right?
Yeah.
Your taxpayer ID number, or TIN.
Absolutely critical distinction here. An SSN, Social Security number, that's for citizens and people authorized to work.
Right.
An ITIN, Individual Taxpayer Identification Number, always starts with a 9. It's only for tax processing. It does not give you work authorization or Social Security benefits. People mix this up sometimes, but it really impacts what tax benefits you can get.
So connect the dots for us. How do these different TINs affect tax credits?
It means pretty significant limitations if you only have an ITI. For example, the Earned Income Tax Credit, the EITC, very valuable.
Yeah.
You generally can't claim it unless you, your spouse, if filing jointly, and the qualifying child all have SSNs.
Okay, no EITC with ITNs. What about the child tax credit?
That's a bit different. The filer, the parent, can have an ITN, but the child absolutely must have an SSN to qualify for the main child tax credit.
Ah, the child needs the SSN.
Exactly. However, there's another credit, the credit for other dependents, or ODC. It's smaller, $500, and non-refundable, but it's available for dependents who don't qualify for the CTC, including kids or other relatives who have an ITN. That's a key one for many families.
Good to know. Okay, so we've got residency, we've got TINs figured out. The next big strategic choice seems to be filing status. Where's the advantage usually?
Well, the tax code definitely heavily favors married filing jointly, MFJ. For 2024, the standard deduction for MSJ is nearly double what single or married filing separately get. Plus, the tax brackets are wider, meaning more income is taxed at lower rates.
So lower tax overall.
Often, yes. But it's more than just the deduction. MFJ kind of unlocks access to a whole range of other credits, things like education credits, childcare credits. Many of them require you to file jointly. It really is the foundation for optimizing taxes for many families.
That makes sense, but are there any situations where married filing separately MFS actually makes sense, even though it usually means a higher tax bill?
Yes, but they're pretty specific, narrow scenarios.
Like what?
Okay, imagine one spouse has incredibly high medical expenses. Filing separately might, maybe, allow them to deduct more because the threshold is based on a lower individual income, or sometimes it factors into student loan repayment plans based on individual income.
Okay.
But honestly, the most compelling reason is usually legal, not financial. MFS completely separates your tax liability. You are not responsible for your spouse's tax debts or any errors they might make on their return. That can be a crucial protection sometimes.
Gotcha. Protection. What about head of household, HOH?
HOH is a big advantage over just filing single. You get a significantly higher standard deduction, wider tax brackets than single, too.
Who qualifies?
The key is often the considered unmarried rule. Basically, even if you are married, if you lived apart from your spouse for the last 6 months of the year, file a separate return, paid more than half the cost of keeping up your home, and had a qualifying child living with you for more than half the year, you might qualify for HOH. It's really vital for many single parents.
Okay, that makes sense. Lastly, let's talk dependents. How do they actually turn into tax savings?
Claiming dependents is huge. It unlocks some really powerful credits. We mentioned the child tax credit that's up to $2,000 per qualifying child. Remember, the child needs that SSN.
Right.
And the credit for other dependents, the $500 one for those who don't qualify for the CTC, like kids with IETNs or maybe an elderly parent you support. There's also the Child Independent Care Credit, helps offset costs if you pay for care so you can work. And education credits, like the American Opportunity Tax Credit for college costs. Dependents are key to accessing these.
Now, what I find really interesting is how separated parents can sometimes strategically split these benefits. How does that work?
Yeah, this connects back to filing status and dependence. Typically, the custodial parent, the one the child lives with more, gets to claim head of household status, assuming they qualify, and the Child Independent Care Credit.
Okay.
They can choose to release the dependency exemption itself, and crucially, the valuable child tax credit to the non-custodial parent.
How do they do that?
There's a form for it, Form 8332. The custodial parent signs it. This becomes a really powerful negotiating tool in divorce or separation agreements. It lets the parents decide who gets the biggest tax bang for the buck from the child, maximizing the overall family tax relief. Someone should get that credit.
That's fascinating. Okay, so wrapping this up, what's the big takeaway for our listeners?
Well, I mean, understanding these U.S. tax rules, it's definitely a journey, right? Not a one-time thing.
For sure. Your residency status really is that master key. Get that right first.
Exactly. And then your filing status acts as a powerful lever for potential savings.
And dependents, properly claimed, can unlock some serious financial relief through credits.
And don't forget, the TIN type SSN versus ITIN makes a huge difference in which benefits you can actually access.
Right.
Which brings up, I think, an important final thought. Life changes, right? You might get a different visa, get married, have kids get older. All these things can dramatically shift your tax picture from one year to the next.
Good point.
So the real question is, how often are you truly stepping back and reassessing your entire tax strategy? Because what worked perfectly last year might not be the best approach all for this year. Constant vigilance is key.